Maggie Creed. I'm with the CFA Society of Philadelphia. I just wanted to take a second to thank you all for joining us here today. We've had a great turnout for this event. There's a number of folks at the Federal Reserve who helped to put this event together, and I'm not going to go through and mention them all by name, but I would like to thank the Federal Reserve for hosting us here today. And now I'd like to introduce William Canto with the Bond Club of Philadelphia, who is going to introduce our speaker.
Again, let me thank you guys for coming out. A wonderful opportunity. And again, thank you, Dr. Plosser, for coming and speaking to us. Obviously, it's my honor to be able to introduce our speaker. And I'd like to introduce Dr. Charles Plosser, who is the president and the CEO of the Federal Reserve Bank of Philadelphia. In his current role, he participates on the Federal Reserve System's Federal Open Market Committee, which is responsible for conducting our nation's monetary policy. Dr. Plosser joined the Federal Reserve in 2006. During his term, he and his colleagues have faced the challenges of a global financial crisis followed by a severe recession. The Federal Reserve took unprecedented action in both monetary policy and in its lending operation that helped mitigate the effects of the financial crisis and address the deteriorating economic growth. After the crisis, as financial regulatory reform was being debated, Dr. Plosser stressed the need to preserve the Federal Reserve's independence and structure by drawing a distinct line between fiscal and monetary policy. He also argued the reform must end the notion that any firm is considered too big to fail or risk sowing the seeds of the next financial crisis. Dr. Plosser also believes in a systematic approach to monetary policy to promote better economic outcomes and financial stability. He has been a longtime advocate of the Federal Reserve adopting explicit inflation targets, which they adopted this past January. Before joining the Federal Reserve, Dr. Plosser was an economics professor at the University of Rochester's Business School and was the dean of the business school from 1993 till 2003. His research includes monetary and fiscal policy, long-term economic growth, banking and financial markets. He was the co-editor of the Journal of Monetary Economics for 20 years. He earned his MBA and PhD degree from the University of Chicago. So please help welcome Dr. Plosser.
Thank you, William, for that very kind introduction. I'm delighted to be here. I want to welcome all of you to the Federal Reserve Bank of Philadelphia. It's delightful to have you here, and I want to thank the CFA Society and the Bond Club for inviting me to speak today. You know, William mentioned I started in 2006. My very first speech as president of the Federal Reserve Bank of Philadelphia was to the CFA Society in October of 2006. A lot's happened since then, and the world has changed quite a bit. So I obviously don't have time to recap everything that's happened since the last time I spoke to you, but I do talk a little bit about the current state of the economy and a little bit about monetary policy as well. So our gathering comes at an appropriate time, at an opportune time. And it's just 2 weeks ago, I participated in the most recent meeting of the Federal Open Market Committee, which, as William told you, is the committee within the Federal Reserve System that determines monetary policy. Now, 4 times a year, and most recently at our last meeting in September, FOMC participants submit their economic projections for output growth, inflation, and unemployment based on their assessment of appropriate monetary policy. This summary of economic projections, known as the SEP in the lingo of the Fed, gives a perspective on various participants' views about how monetary policy can achieve the goals that Congress has set forth for it. Specifically, the Federal Reserve Act states that the Federal Reserve should conduct monetary policy to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. Now, since moderate long-term interest rates generally result when prices are stable and the economy is operating near full employment, it's often said that Congress has given the Fed a dual mandate. Monetary actions, however, generally affect the economy with a lag. So the FOMC must be forward-looking in calibrating the appropriate stance of policy. Therefore, I want to begin my remarks today by talking a little bit about the nation's economic recovery and my outlook for growth and inflation. I'm then going to offer some observations on current monetary policy, including the actions that were taken at our last meeting. Before continuing, I have to make the usual caveat that my views that I express are mine, not necessarily those of the Federal Reserve System or my colleagues on the FOMC. So let me begin with the state of the economy. We've now seen 3 years of economic expansion since mid-2009 when the recession officially ended. Yet no one would describe our nation's economic state of affairs as satisfactory. Economic growth has come in fits and starts, taking 2 steps forward only to take 1 step back. Most disheartening, of course, is that the unemployment rate remains very high, affecting millions of Americans and their families. After finishing 2011 with a 4.1% growth in the fourth quarter, growth of real domestic product in the United States slowed to 2% in the first quarter of this year, and then to 1.7% in the second quarter. We are likely on a trajectory that will lead to growth of about 2% for the full year. Looking out a little further, I anticipate that the pace of growth will pick up somewhat to about 3% both in 2013 and 2014. That 3% is just a little above trend for the economy. Now that places me near the high end of the central tendencies of the FOMC participants' forecasts for 2013 and near the lower end of the central tendencies for 2014. In fact, in September projections, the central tendency for growth for this year, 2012, was between 1.7 and 2% this year, followed by a growth of 2.5 to 3% in 2013 and a growth rate between 3 and 3.8% in 2014 and 2015. So one factor contributing to sluggish growth in the very near term is, of course, the drought in the Midwest and its effects on this year's crops. Estimates vary, but the drought will probably cut about 0.5 percentage point off of growth in the second half of this year. Sluggish manufacturing activity has been another reason for the recent moderating growth estimates. The Philadelphia Fed's monthly business outlook survey of manufacturers has been a useful barometer of national trends in manufacturing over many, many years. The survey's general activity index posted a few negative readings last summer and then returned to positive numbers through most of this till this spring. Then we saw a return to some negative numbers in our general activity index this summer. So while the readings for the past 5 months have been negative, recent readings have been improving. And in the latest survey, it suggests that manufacturing activity in the region was essentially flat from August to September. Despite these current weak readings, though, the survey's indicators of activity 6 months out have remained positive throughout this period and throughout the recovery, and had announced bounce up in September, suggesting that manufacturers, of course, are somewhat more optimistic looking forward. Consumer spending, which accounts for about 70% of the nation's GDP, also continues to make modest gains. In July, the Bureau of Economic Analysis reported that personal consumption expenditures, PCE, increased $46 billion, or about 0.4% last month. That followed a weak reading in June when consumer spending increased just $3.5 billion. We need to keep in mind, though, the extent and magnitudes of the shocks that the financial crisis and the ensuing recession imposed on the economy. The housing bust that precipitated the crisis destroyed a lot of household wealth. It's only natural and rational for consumers to want to rebuild the savings that they were lost as a result of the decline in housing wealth. Savings that they might have used to send their children to college or to help fund their own retirement. Consequently, private savings rates have risen substantially over the last several years. Between the year 2000 and 2007, private savings averaged less than 5% of GDP. Between 2008 and 2011, the saving rate averaged 7.5%. Thus, it's not surprising that consumers are not the engine of growth they normally are in some expansions. Indeed, they are unlikely to provide robust growth boost to demand until the health of their balance sheets is improved. There are encouraging signs, however, in the housing sector as it's beginning to improve. Of course, we entered this recession overinvested in residential real estate, and we are not likely to see a strong housing recovery until the surplus inventory of foreclosed and distressed properties declines. Moreover, we really do not want to have housing activity return to those heady days of 2005 and 2006. What we learned was that activity was unsustainable and a prime contributor to the financial crisis that ensued. On the labor front, the pace of employment growth this year has not been strong enough to have much effect on the unemployment rate. Firms added an average of 226,000 jobs a month on net during the first quarter of the year. Then in the spring, in the second quarter, it dropped to just 67,000 jobs a month. Though the first 2 months of the third quarter are in, so far in the third quarter, we've jumped back up from that 67,000 to at least the first 2 months of 118,000 average per month. At 8.1%, the unemployment rate is still elevated and too high for everyone's taste. But we should remember that 8.1% is a full percentage point below where it was this time last year. In the FOMC's economic projection in September, FOMC participants' central tendencies suggest that the unemployment rate in the fourth quarter of this year will be close to where it is now, between 8 and 8.2%, and then fall gradually to between 6 and 6.8% by the end of 2015. My own forecast is on the optimistic side of that range, but within those ranges. I wish we had better numbers to report. I wish the employment situation was improved. The sizable shocks that hit the economy resulted in the loss of 8.8 million jobs. From the peak of the employment in January 2008 to the employment trough, which was February of 2010. We have regained fewer than half of those jobs. In my view, the frictions and structural adjustments that are holding back improvements in labor cannot be cured by monetary policy. Nor can monetary policy do much to speed up the slow progress we are making on the labor front. Turning to inflation, it's been running near our longer-term goal of 2%. Although the drought in the Midwest and higher gasoline prices that we've seen recently are likely to push inflation up in the near term, these effects should be transitory and gradually dissipate over time. Thus, I don't see much evidence that we will have an outbreak of inflation in the near term. I see elevated risk of deflation, which is one of the motivating factors for our exercise in the fall of 2010 we called QE2. Indeed, over the medium term to longer term, I expect inflation to be near our 2% target. But this expectation of mine is incumbent on the Fed following appropriate monetary policy. And I have to confess that my assessment is that the appropriate policy is likely to be somewhat tighter going forward than broadly anticipated by the committee at this point. Thus, with the committee's view so far, I do see, going forward, I do see some risk to inflation in the longer run, given the current stance of policy, and I'll discuss more about that in a few moments. Of course, there are other risks that cloud the forecast. While the recent policy actions in Europe may have calmed markets and eased financial conditions somewhat, many fundamental issues remain in Europe and remain unresolved. There's still a great deal of uncertainty as to whether the Europeans will make the difficult choices needed to put Europe back on a sustainable fiscal path. Our own fiscal policy is also highly uncertain. While I believe we will avoid the worst-case scenarios related to the falling off the fiscal cliff, as they call it, the U.S. still needs to forge a path forward with sustainable fiscal policy. These uncertainties constitute significant hurdles for the economy and are currently retarding very near-term growth. So let me turn now to some thoughts on monetary policy. Even before the actions we're taking at this last meeting this month, the Fed had put in place extraordinary measures to support the recovery. The Fed has kept the federal funds rate near zero for more than 45 months. It has completed 2 rounds of asset purchases that have more than tripled the size of our balance sheet. Still implementing the maturity extension program, or as popularly known as Operation Twist, which is lengthening the maturity structure of our holdings of Treasury securities. All these actions have substantially changed the composition of our portfolio, from mainly short-term Treasury securities, which is mostly what we held before the crisis, to now long-term Treasury securities and long-term housing-related securities now. Now, many of these actions were taken at the height of the financial crisis and the ensuing deep recession. But the financial crisis has substantially abated. Markets are functioning, and they're largely functioning normally. And the economy has been healing, if somewhat more slowly than we would like it to. In fact, if you compare today's economic environment and financial conditions to the conditions that prevailed when the FOMC last took bold action, say QE2, you will see the economy is undoubtedly in a better position, but probably not as far along as we'd like it to be. At its latest meeting in September, the FOMC decided to begin a 3rd round of quantitative easing, commonly called QE3, with the purchase of additional agency and mortgage-backed securities at a pace of $40 billion a month. The FOMC indicated that if the outlook for the labor market does not improve substantially, the Fed would make these purchases and more, and would employ other tools as appropriate until such improvement is achieved within the context of price stability. I interpret within the context of price stability to mean so long as the inflation outlook remains near the committee's 2% goal. The FOMC statement also said that the economy expects a highly accommodative stance of monetary policy to remain appropriate for a considerable period of time after the economic recovery strengthens. It also stated that the committee currently anticipates that exceptionally low rates for the federal funds rate are likely to be warranted at least through mid-2015. Now, the committee's decision was based on the view that with unemployment far above the level typically seen in normal times and inflation near its goal, increasing the amount of monetary accommodation should help bring unemployment down without jeopardizing inflation goal. And since the Fed said it expects to keep substantial accommodation in place even after the recovery strengthens, people and businesses should be reassured that the recovery will remain intact, even in the face of future adverse shocks. This should make households and firms comfortable spending more today rather than saving, which should in turn improve hiring. I oppose the committee's actions in September because I believe that increasing monetary policy accommodation is neither appropriate nor likely to be effective in the current environment. Every monetary policy action has costs and benefits. They are not free. And my assessment is that the potential costs and risks associated with these actions outweigh what I perceive to be the potential somewhat meager benefits. Given the magnitude and nature of the shocks that hit our economy, one should not be particularly surprised by the slow recovery. Both the housing and financial sectors suffered large declines, and it will take time for the economy to adjust. While unemployment is expected to remain above the participants' range of estimates for its longer-term level for some time, it is not at all clear that monetary policy can speed that transition. In other words, the slow pace of the recovery should not be taken as evidence that the stance of monetary policy is inappropriate or that ever more aggressive action can speed up the pace of that recovery. Indeed, many economists outside the Fed and elsewhere expect that the further asset purchases by the Fed are unlikely to reduce long-term interest rates by a significant amount. Some studies suggest that the effect will be quite small and transitory. So given our current economic situation and my reading of the empirical evidence, I do not believe that lowering long-term rates by a few more basis points will spur further growth or higher employment. Business leaders who I've talked to continue to cite uncertainty about fiscal decisions in particular, both here and abroad, as the greatest hindrance to hiring and investment. Hopefully, these uncertainties will abate over time, but the central bank can do little to alleviate those uncertainties. They will remain. As far as households are concerned, they continue to try to repair their balance sheets in the wake of the substantial losses of housing wealth, as I indicated earlier. They are deleveraging and saving more. It seems unlikely that another small drop in interest rates will overturn that strong desire to save and instead induce households to spend significantly more. In fact, driving down interest rates even further may encourage consumers to save even more to make up for the lower returns they're earning on their savings. Thus, in my view, with these conflicting forces, we are unlikely to see much benefit to growth or to employment from further asset purchases. If I'm right, then conveying the idea that such actions will have a substantial impact on labor markets and the speed of the recovery risks the Fed's credibility. This could be quite costly. If the public loses confidence in the central bank, our ability to set effective monetary policy in the future will be harmed, and households and businesses will feel the consequences. Now, the recent actions risk the Fed's credibility in other ways as well. The rationale for the actions leading to increased spending today, or the rationale for the actions that would lead to increased spending today, depends on the Fed's ability to convince the public that it will conduct monetary policy in a fundamentally different way than it has in the past. We must change expectations. People must believe that we will delay raising interest rates compared to when we normally would raise them, and by so doing, make the economy stronger than it otherwise would be. However, in order for this strategy to work, people must believe that we will ensure that inflation expectations do not take off and threaten longer-term price stability. Making such a change in the policy regime believable will be very hard to do. If the public doesn't believe that we will delay raising rates, they won't bring spending forward and the policy will be ineffective. But if they do believe that we will delay raising rates, and then they infer that the Fed is willing to tolerate considerably higher inflation, perhaps, this may spur an increase in inflation expectations and a rise in nominal long-term interest rates, which would ensure and require a response on behalf of the FOMC, or else it risks its own credibility and its commitment to keep inflation low and stable. I do not think it prudent to risk that hard-earned credibility that took us over 20 years to acquire. Thus, the subtlety and complexity of successfully managing expectations in this manner make this quite a risky policy in my view, with little evidence of quantitatively meaningful results for unemployment or employment. Continued expansion of the Fed's balance sheet has other costs as well. By greatly expanding the size of the Fed's balance sheet, the new asset purchase program will exacerbate the challenges that the Fed will face when it comes time to exit from this period of extraordinary accommodation, risking higher inflation and harm to the Fed's reputation and credibility. I've been a student of monetary theory and policy for over 3 decades now. And one constant theme is that central banks tend to find it easier to lower rates than they do to raise them. Moreover, identifying turning points is difficult, even in the best of times. So timing the change in direction of policy is always a challenge. But this time, exit will be more complicated and more risky. With such a large balance sheet, our transition from very accommodative policy to somewhat more less accommodative policy will involve using tools that we've never used before, such as interest rates on reserves, term deposits, and asset sales. Once the recovery takes off, long rates will begin to rise, and banks will begin lending the large volume of excess reserves sitting in their accounts at the Fed. This loan growth could be quite rapid, as it was after the banking crisis in the 1930s, and there's some risk that the Fed will need to withdraw accommodation very aggressively in order to contain inflation. At this point, it's impossible to know whether such asset sales would be disruptive to the market. We just don't know. A rapid tightening of monetary policy may also entail political risks for the Fed. We would likely be selling assets, the longer maturity assets, in our portfolio at a loss as interest rates go up, meaning that we may, at some point, be unable to make remittances to the U.S. Treasury, perhaps for some years. Yet on the other hand, if we don't tighten quickly enough, we could find ourselves far behind the curve in restraining inflation. So while these risks are very hard to quantify and to pin down, it's clear the larger the Fed's portfolio becomes, the higher risks and the higher potential costs we face upon exit. Based on my economic outlook, that time may come well before mid-2015. In my view, to keep the funds rate at zero that long would risk destabilizing inflationary expectations and lead to unwanted increases in inflation. In fact, some are interpreting the FOMC's statement that we will keep accommodation in place for considerable time, as I alluded to earlier, after the recovery strengthens, as an indication that the Fed is focused on trying to lower unemployment rate and is willing to tolerate higher inflation to do so. This is another risk to our hard-won credibility that the institution has built over many, many decades, and which, if lost, will be hard to regain. That credibility is expensive to earn and easy to lose. Now, some of my colleagues on the FOMC have advocated giving quantitative triggers, or thresholds as they call them, for the level of unemployment rate and inflation to explain the economic conditions under which that would lead the Fed to consider a change in the policy stance. For example, the Fed might communicate and indicate that extraordinary accommodation would remain in place if unemployment were above, say, X percent, and as long as the outlook for medium-run inflation is not higher than, say, Y percent. Then you can pick your favorite numbers. I do believe strongly that policy should be state contingent and systematic, and that the FOMC should strive to explain its policy reaction function. That is, reaction function, it describes how policy is expected to change as economic conditions change. A Taylor rule is one such reaction function, but research indicates that other simple rules are good guides to policy, even when the true model of the economy is not well known and uncertain. Usually these rules, economists have found, involve policy responding aggressively to deviations from inflation from its target, and also responding to deviations of output from some concept of its potential. In addition, these rules tend to involve some smoothing of policy so that rates don't jump very suddenly as economic conditions change. Using such robust rules, as economists call them, as guides to policy, is, in my view, the appropriate way to communicate policy guidance. As a result, as many of you know, I've never been an advocate of the calendar date forward guidance that we started a year ago in August. I thought it was a mistake when we implemented that language, and it remains a nettlesome problem, communications problem for the Fed. But while the unemployment and inflation thresholds do move away from the calendar date guidance and towards the more economic conditions, they fall short of a reaction function that I would like to see, as they say nothing about how monetary policy will change after such thresholds are reached. Will the FOMC tighten quickly? Will it tighten slowly? Will it wait longer? How will it do relative to what it's done in normal times or in other times? How will the Fed decide what it's going to do after the thresholds are reached? The triggers or thresholds tell us nothing about how our behavior will evolve after that. Moreover, the unemployment rate is not the only labor market variable that may be of interest. Indeed, unemployment rates fell 0.2% in August. Yet few think that that represented improved labor market conditions, as the reduction stemmed from a decrease in the participation rate rather than an increase in employment. In addition, I'm not convinced that the inflation trigger in these approaches would prove to be much of a constraint. While the unemployment trigger is based on the current value, the inflation trigger is based on the outlook for inflation. The outlook. And everybody's outlook may be somewhat different. But if monetary policy is appropriate and being set appropriately, this outlook should be consistent with price stability, the 2% goal. So when and ever will the outlook for medium-term inflation go above or trigger the threshold events? Thus, I believe that using thresholds or triggers could easily put us behind the curve, particularly if we have a tendency to underestimate future inflation. Finally, I also oppose September's decision to purchase additional mortgage-backed securities. In general, it's my view that central banks should refrain from preferential support for one sector or one industry over another. Those types of credit allocation decisions rightly belong with the fiscal authorities, not the central bank. Engaging in such actions, in my view, endangers our independence and the effectiveness of monetary policy. So to summarize, the U.S. economy is growing and continuing to grow at a very moderate pace. We always use moderate and modest. You know, people wonder what the difference is, and I'm not sure I know what the difference is, but that's why I use them interchangeably. The people who read the statements seem to think they're very different. But anyway, I believe that inflation expectations, prospects for labor markets will continue to improve gradually. I believe inflation expectations are relatively stable, and inflation will remain moderate, at least in the near term. However, with the very high level of accommodation in monetary policy today, and has been for 4 years, we must guard against the medium and longer term risks of inflation in our exit strategy, not to mention the further distortions that zero interest rates may be causing or can create within the financial system. The Fed's most recent actions carry with them, I think, significant risks. I'm not forecasting that those risks will necessarily materialize. In fact, I hope they will not. But if they do, they could prove quite costly to the economy. It's therefore important, from my perspective, that we understand those risks and evaluate them in assessing our policies. A common error in policy making throughout government in many dimensions is the excessive focus on the short term and the underestimation of the longer-term effects and longer-term consequences of policy choices. I take the longer-term risk I've outlined today quite seriously. In my view, the potential costs outweigh what appear to be some meager potential benefits of these policies, either of further asset purchases or extending the forward guidance. Finally, it's important to me that the Fed's policy making remain credible to the public. That has important benefits to our economy. I believe the FOMC should continue to work towards increasing the public's understanding of how we will react systematically and through time to changes in economic conditions. Improving the transparency of our monetary policy decision-making process will help improve the effectiveness of monetary policy and the Fed's accountability to the public. For those reasons, I would prefer that we pursue a more systematic approach to policy rather than just simple thresholds and triggers. Thank you very much. I'll be happy to take some questions.
Is there a long-term plan for what the Fed's going to do with all this?
Well, our balance sheet is mostly made up of long-term treasuries and mortgage-backed security. And in June of 2011, we laid out a strategy for how we would exit. And it gave out some goals and objectives about how we wanted to exit. And there were 2 or 3 parts to that. One was that we sought to return to using the federal funds rate as our primary instrument of policy. One implication of that is that we will have to shrink our balance sheet in order to be able to implement that tool. The second thing was that we would use, as we begin to exit, we would use interest on reserves and other tools at our disposal to manage interest rates up while we shrunk our balance sheet. And our desire is to shrink the balance sheet gradually over time in a way that doesn't disrupt markets or create lots of problems in the financial markets or for the economy, broadly speaking. And the goal would then be to use these other tools over time to manage the balance sheet down. Preferably, the easiest thing to do would be just let the assets gradually run off over time and then not replace them. That would be one way of doing it. As I alluded to in my remarks, the challenge we'll face is that will we have the luxury of allowing that to happen, or will we be forced into literally selling assets in the open market in order to shrink the balance sheet? That's going to be more of a challenge. We don't know that that's going to be necessary. I'm not predicting that's necessary. But if you have plan A, it's always good to have a plan B. And so we must be aware of the consequences and the strategy we employ to do that. But our goal is to shrink the balance sheet back to more normal levels and to return the federal funds rate as our primary instrument of target, which means moving it away from primary instrument of policy. That means moving it away from zero.
Why do you think the Treasury Department did not just say, this debt's called, it's gone, it's redeemed?
Well, they could do that if they so chose. I'm not sure why they would choose to do that. Oops. It wouldn't benefit them particularly because most of what they give us, we return right back to them in remittances to the Treasury. So last year, the Fed returned $70 to $80 billion to the U.S. Treasury, which is basically the interest on the earnings of the portfolio. So it just goes right back to the Treasury. So there's no particular game to be played there at the end of the day. So I think that's possible, but I'm not sure it would be very effective at solving any of our country's problems or inflationary problems. Other question?
Based on the economy and what the Fed is doing right now, there is more hope about reducing the balance sheet. Going in the wrong direction.
Well, yes, we are. Right now, we're making it bigger. Well, that's why is that I'm worried that the actions we are taking to make our balance sheet bigger entails risks, and those risks could be quite substantial. And what does the Fed do? Well, my view is that I'm not sure the Fed can do much about that. And that's my concern. I think the efforts that we are pursuing at this point have, at best, minimal impact, particularly on employment and output.
Just one last point based on the announcement over the last week. The Fed would continue with its open policy of buying, at this point, mortgage-backed securities.
Yeah, so imagine the following. Imagine the following scenario, since this is an open-ended commitment, and suppose the policy tool that we're using, which is asset purchases, if that policy tool doesn't work, and the economy remains in a funk, if you will, for a long time, how long will we be buying this stuff? And how big will our balance sheet get? I think those are the kind of risks. Those are the kind of risks we have to deal with. Another question?
Over the past 2 or 3 decades of following monetary policy, have there any big, you think about especially in how the economy responds to monetary policy through inflation potentially. It seems like, have you seen any big changes, particularly in energy? I hear a lot about how, recent enormous discoveries of natural gas in different parts of the world, and certainly the dislocation that's happened between gas and petroleum prices has really kept a lid on what would historically have been raging inflation. It kept a lid on certain large sectors of the economies don't consume much petroleum, and they've seen deflationary energy prices. Is it ever the case when when you're looking out at inflation expectations, you take that into consideration and say, geez, maybe there's been a structural change in, maybe just as a, for instance, that one big piece, or maybe something else in, structure to, how inflation actually is going to hit the U.S. consumer?
So there have a dozen different dimensions to what you asked. So let me see if I can address inflation directly. Inflation is the general rise in all goods and services. Relative price changes between different goods and services occur all the time. And indeed, that's how market economies work. The higher oil prices and lower gas prices will signal to the marketplace to shift people from oil to gas. That's exactly what you want to have happen. And that's what the market's telling you has to happen. So the challenge of looking at inflationary expectations and determining what the future path of inflation has in part to do with looking through all the monthly changes or in relative prices. And sometimes that's hard to do, particularly when you've got some prices that spike up very sharply in the short run only to come back down. Over the last 3 years, we've seen this happen 2 or 3 times with oil in particular and gasoline prices in 2008 and again early this year, where things spiked, inflation ran up very sharply for a brief period of time and then came back down. So the challenge of understanding what the outlook for inflation is going to be, and therefore what monetary policy needs to incorporate, is seeing through those relative price changes and figuring out what the underlying inflation rate really is and what that transmission is going to be. Nobody has a good model or theory about how to do that well. It's based on experience, it's based on econometrics, it's based on data and other things, but it's hard to do. So you don't always know whether or not, a lot of people point to gold. Big rise in gold prices, that's an inflationary hedge, and that must mean inflationary expectations are going up. Well, that may be true for people buying gold. That may be why they're buying it. But the question is, do you see that behavior in other prices, in other forms of expectations of inflation, in the tips market, other markets? Is that translate through? So this is not an easy game, not an easy thing to do. And determining what expectations are is a challenge. But we have various measures to look at. We have measures from the financial markets. We have the actual inflation rates. We have forecasts from consumers about their expectations of inflation. We have surveys of economists about what their expectations are. So we try to use all that data to help us disentangle all the bouncing around that goes on to keep a handle on inflationary expectations.
I can't help but ask you a follow-up. What do you make of gold prices where they are today?
No, I'm not going to time it on gold prices. Yes. Right next, right.
So switching gears a little bit maybe to the MBA rather than the PhD degree. I have a question about the banking system.
About the
banking system, and specifically whether you believe that the ECB's most recent moves and the OMT or the MOT, if you're using French grammar rules, has done enough to cut off the potential for cross-border banking system contagion.
I don't think anybody knows the answer to that yet. It's certainly clear that the Europeans are seeking ways to sort of do that through trying to consolidate oversight of the banking system. That's not implemented as yet, and so we'll have to see how that works and whether it's desirable or not. But the fundamental problem in Europe, as I see it, is a fiscal policy problem. It's a debt problem. And I don't care what monetary policy can't solve that problem any more than monetary policy can solve the fiscal cliff problems in the United States. And indeed, oftentimes the danger when monetary policy goes awry in many countries, even in the U.S. at times, is the danger when governments end up trying to use monetary policy to solve a fiscal policy problem. And that usually leads monetary policy awry. It's happened many times in many countries around the world and at different times, and it's one of the lessons of why central banks are independent, is to prevent them from being led too far astray by fiscal problems. But that line, as I've said in many speeches before, during this crisis has been blurred. During the crisis, not just here in the United States, but in Europe, Japan, England, central banks are under a lot of pressure from the public and from fiscal authorities to do something about things that they may not be able to do much about. And the dangers of abrogating that independence or succumbing to the pressure to be fiscal agents in that sense can be very, very damaging, and we need to guard against that. I wish it's easier said than done sometimes. A couple more questions up back in the back.
When you think about the channels to which QE is effective, you have yields, which you discussed earlier, you have appreciation of the dollar, which is difficult for the ECB, the SME, and the DOJ. And you also have an increase in asset prices. I'm wondering if you can talk about how effective you would think an increase in asset prices would be effective for QE.
Let me be very clear. Monetary policy does not create wealth. It does not create true wealth. Asset prices, imagine a world in where, let's forget about unemployment for the moment, just the economy is running along. Lowering the if asset prices and stock prices are discounted present values of a stream of earnings or dividends, or however you want to think about it. All a change in the discount rate does is raise the value today, but you pay a price for that, don't you? Because you get a lower yield going forward. You just rearrange the timing of things a little bit. So that doesn't create any real wealth. The only way that monetary policy could create wealth or improve the efficiency of the economy is if, in fact, the reduction in interest rates, and we can debate about what the channels are of this, I have my own views about this, but the logic is that by reducing interest rate, you increase aggregate demand, which puts more people to work than otherwise would have been at work. That improves the efficiency of the economy. It works through that channel, not through asset prices to employment. So I think we have to be very careful about thinking about monetary policy goals as manipulating or moving around asset prices. I very much am uncomfortable with that way of thinking about channels of movement. Certainly in terms of the dollar, everybody's guess as to what determines exchange rates is as good as anybody's these days. I used to teach MBA students, and I said, if somebody's going to tell you how to beat the market on exchange rates, you better walk the other way as fast as you can. We have some ideas as economists, all right, but obviously there are two channels that could work through. That is interest rate effects, and look at carry trade and other things as interest rates would move. Or you could see the decline in the dollar as being symptomatic of expectations of higher inflation, which would depreciate one currency relative to another. But it's all got to be bilateral. So, I think those are channels that can be operative, but I think understanding them and being able to manage them in an effective way is, again, easier said than done. So, right here.
Your views on monetary policy have been consistent over the years. I'm not surprised that you represent that. But what I am surprised by is the difference between the survey of economic projections in June and that in September. Not that much different. Yet the FOMC seemed to make a bold move here, both in terms of the guidance and in terms of the asset purchase. Some of your colleagues have changed their view. President of Minneapolis, for example, who was sort of philosophically aligned, being a hawk, jumped to, well, this key policy easy when the unemployment rate falls to 5.5. It's sort of a switch. We've had a couple things that in between those two surveys, in between the meetings associated with it. One was the employment report for August. But what really has changed to sway so much of the committee towards a more aggressive accommodation between June and September?
you're probably asking the wrong person, but so I think there are two real things that are going on. You know, the economy did start off the year much stronger, and it has gradually waned. There's lots of debate one can have about why that is the case. What's the underlying mechanism that's at work? The Fed does have, by law, this dual mandate. I think the Fed, like every other American and every other policymaker, is incredibly disappointed and frustrated by the pace of the recovery. And I think that it's fair to say we've done an extraordinary amount of accommodation and effort put into this with perhaps less than spectacular results, maybe you could say. We've accomplished some things. Clearly, in my view, the first round of asset purchases, QE1 in 2008 or 2009, you know, markets were not working. They were fundamentally dysfunctional for a long period of time. I think the Fed did some important things. I didn't agree with all of them, but did some important things to maintain the liquidity and functioning of the marketplace. I think that we've kept interest rates at low for a long time. There are risks to that policy too. QE2, I think, actually had more effect on inflationary expectations because we were much closer to really experiencing unacceptably low inflation in the fall of 2010. I think we responded there, and I think that had some modest effects, particularly on inflationary expectations. It's not clear very much on employment and output growth. So there are two things you can think about taking away from this period of what effects we've been able to discern empirically from what's going on. One hypothesis is we have to do more. The reason we haven't been more effective is because we haven't done enough. The channels and the principles are right, and we just have to keep doing it until it gains traction. That's one perspective. The other perspective is a little different, which is kind of where I am, which is, look, this hasn't done as much as we thought it would do. It hasn't been as effective on the real economy as we thought it might. You can say, well, does that mean we haven't done enough, or it means it just doesn't work? Those are two very different stories. And if you conclude that perhaps it's not effective and that doing more won't help any more than it did in the past, then you get a little different perspective on how to move forward. So I do think that all of my colleagues, all of us on the Federal Reserve, in the Federal Reserve System and on the FOMC, we want the economy to do better. We care about the state of the economy. We want to do the right thing. But these are in such extraordinary times with very little empirical evidence for us to go on in many respects, that we're having to make judgments. And you've got a lot of people in the room who are making judgments, just like me. Some of them make different judgments than I do, that's the way policy in a committee works. But they're just trying to do the right thing. And I think between what happened, I think, over the course of the summer, as the economy failed to pick up, European crisis was dragging it down, election uncertainty, fiscal policy uncertainty, many of us thought that those were not much we could do about. We couldn't bring the economy away from that. Others say, well, if we just do enough, we can take some insurance out against downside risk, as they like to say, and try to be effective. We did take more action in June with extending the Operation Twist. But I think there just remains a lot of, I would say, frustration on us trying to deliver on what people expect us to deliver on. And I would add to that answer that one of the things that I think the Fed and the public need to be cautious about is I think that over the years people have built up expectations of what monetary policy can do way beyond what we're capable of delivering on. And if we continue to feed into those expectations, we can do more, we can do more, we can do more, we can fix this, then we are setting ourselves up for a big fall. And I think that we should have a little more humility and have the public understand their limits to what monetary policy can do. And I've argued for many years, even before I came into the Fed, and I've argued it in speeches here, that there are limits to what monetary policy can do. And I'm very concerned that we're reaching those limits, if not already there. And some humility about acknowledging that actually could benefit the economy over the longer term. Okay, thank you all for being here. I enjoyed it, and I enjoy your lunch and the rest of the day.